So firstly, I'll introduce Mr. PD Singh to you. PD Sir, as we call him, one of the founders of MDAE, on the advisory board, and always at hand to help us, guide us in everything that we do. All of you must be knowing that recently, there was a lot of jubilation amongst us when Mr. PD Singh was appointed the CEO of JP Morgan Chase Bank India. He was already the head of corporate banking. Now, PD sir has been at JP Morgan for 25 years, since 2010. He's got over 25 years of banking experience. And when I say he has been at JP Morgan for 2010, I would ask all my young friends to carefully look at such careers and see where people reach, where capable people reach when they spend time, a long time with the same organization, because I know you're from the generation of switching every 2 years for 30% extra. Not that everybody does it, but yes, it's very popular. And prior to JP Morgan, PD sir spent 10 years with HSBC in multiple leadership roles. As I said, we are very proud that he's one of the founders of the academy. And I could sit here and talk about how he has transformed the lives of some of our students by mentoring them for a period of 1 year. But that can wait till a later date. Otherwise, we'll never get to the crisis part. Then allow me to introduce Mr. Madan Sabnavis, who's the chief economist of the Bank of Baroda. He was the chief economist of CARE Ratings and NCDEX before that, an alumnus of the Delhi School of Economics and St. Stephen's College. Now, I have never studied economics, and at a very late age, because all my colleagues are economists, I have been making a fervent attempt to understand economics. So, based on what Lord Desai advises us, I read certain books. But one thing I do as a rule is I read the writings of certain eminent Indian economists in the financial newspapers, and Mr. Madan Sabnavis is one of them, right? So, and all of these are friends of the academy. It's such an honor, Mr. Sabnavis, Ajit Chinoy, Dharmakirti Joshi, Niranjan Rajadhyaksha, Ajit Ranade. I never miss what they write in the newspaper. So I would advise students also to keep an eye open for whenever Mr. Madan Sabnavis runs. These are people who, in my opinion, as you know, the economy has several levers, and these are the people who seem to know each and every lever and the interrelation. So very important to read what these people write. So as I said, I won't spend any more time. What we'll do is I'll hand you over to PD sir and Mr. Sabnavis. They'll drive the next 30-40 minutes, but really this has to be interactive, and we are hoping that the students will have a lot of questions around the topic, and the topic broadly is intended to pique our curiosity and elicit questions on the subject of banking crisis. So without any more wastage of time, your time, I hand you over to PD sir and Mr. Sabnavis. PD sir and Mr. Sabnavis, over to you.
Yeah, thank you, Amlesh, for the flattering introduction. I think it's great to have Mr. Sabnavis with us today as well. If it's okay, maybe I can set the context as to what we're talking about, and make Madan do all the heavy lifting and give all the technical stuff. But I think most of us have some kind of interpretation of our own as to what happened or what is happening currently and the way it's playing out. So Madan, if it's okay with you, I'll go first. Great. Thank you. It was great to know that all of you have also studied about the failure of the current in the current situation of the Silicon Valley Bank. So I'd love to ask you a few questions to know exactly what you understood in that session that you went through. And please feel free to keep your cameras on, because I see all your cameras are off. Would be lovely to see some faces who are actually listening to what we are saying. As you know, 3 US banks failed. There was a crisis of confidence in the industry. The collapse of the startup-focused Silicon Valley Bank has rocked the global markets. Alongside with this, We saw the shutdown of Signature Bank, which also had large exposures to digital assets such as cryptocurrencies. And with all of this, we came across a term called a fear of contagion. So since you guys have studied this, or have heard about this, be great to hear from you. What exactly do you understand by contagion? What in this context, what do we mean by contagion? So anyone, please unmute and just contribute to our discussion, please. Okay, would anyone like to talk about why Indian startups went to Silicon Valley Bank? We know that Silicon Valley Bank was very much focused on startups, but why did the Indian startups go to Silicon Valley Bank and open accounts? Great. So let me help you. I think the reason why they went to Silicon Valley Bank, because it was very easy for them to do their banking there. Normally, when you open an account in the US, you need a social security number, you need a tax identification number. A lot of these new age banks did not insist on some of this data, and consequently, it was very easy to do banking. You could open accounts in minutes. The KYC was light touch, and to that extent, I do think some of the benefits our startup, including the Indian startups, was the domain the king. So, story, we saw the US Fed intervene when we had this failure bank, or when we had the issues with this. And can anyone tell me what the US Fed did? Because again, you guys have talked about this, about what the US regulator did to calm nerves and stop this fear contagion.
That took over Silicon Valley Bank and reassured
US,
people money now?
Yeah. Yeah. So they there is a DFC that in deposit up to this amount gets guaranteed.
PD sir, your voice is breaking. It's showing us that your network bandwidth is low. I think we have to wait for him to rejoin.
I out for a minute. I'm really audible.
It's flaky. You know, your video freezes once in a while.
Am I? Yeah.
No. No.
Better now?
The voice is breaking. I mean, it's almost seems like the
Better
network
now?
connection is.
Okay. Just readjust work. Is it better now? Can you hear me now, Amlesh?
It's better now.
Hello?
Yeah, it's better now.
Hello? Yeah, better now?
Yeah.
Okay, great. My question to the student was, are you of a similar deposit for Indian banks and depositors like us? Yeah, I don't know, Amlesh, if I'm audible.
It's better now, but once in a while again, the bandwidth.
Okay. Yeah. Okay. Okay. So in India as well, we have a similar deposit guarantee scheme, which guarantees depositors for up to 5 lakh rupees, and that is DICGC. So this is just to set the context so that you guys understand what the US government did, US Fed did at that time, is to allow that deposits even in excess of the guaranteed amount could be accessible from the next working day, and to assure the public that their deposits with these banks were secure. With this, I think the stress of contagion to other banks was pretty much contained quite quickly. They also made additional funding available to the banks. Does anyone know anything about that? Would you like to share? What additional funding the US Fed made available to the banks in this situation? So essentially, the US Fed set out a banking term funding program. And the banking term funding program provided 1-year funding to the banks against pledge of high quality securities. And these were largely the US government treasuries, agency debt, and mortgage backed securities. So basically, the banks were not forced to divest their securities, and they were able to pledge them to the US Fed and raise money against that. So the liquidity in the system in this time of stress was quickly alleviated. And that's how I think we came along from this in a very short period of time. But then happened Credit Suisse. Credit Suisse was reeling under the sharp decline of their share price and reported material weakness. Does anyone know anything more about this? Why Credit Suisse suddenly had to was perceived as a weak bank?
So
Does
the
anyone
way
know?
in
Yes.
class,
Yeah.
ma'am brought up points about how Credit Suisse for the last few years had sort of gotten a bad reputation. They were quite often caught in scandal, and their management was questioned due to unethical business practices, which is why people sort of lost trust in the bank as well.
Right. So has anyone heard of the term run on a bank? And can you share what your understanding is of the terms of this term?
So the way we've been explained, it's when a banks are supposed to maintain a certain amount of funds at any given point, and it's when the people who are removing their money is a larger amount than the sums that the bank has readily available.
Sure. So it's like when people like you and me are not confident of our deposit with the bank, then we all rush in together and want all our money back at the same time. Whereas the bank has already invested that money or used it to lend or for other purposes. And therefore, not too many banks will be able to withstand if everyone comes together and says, I want my money back and I want it now. Right. So that's the reason why banks, why the term run on a bank is where everyone shows up at the same time. So because this kind of a situation started developing, depositors started withdrawing suddenly their monies out of Credit Suisse. The Central Bank of Switzerland rescued the bank, and they bought back 3 billion francs of debt, and they also subsequently merged this bank with a stronger bank, that is UBS. Again, all of this you must have heard in your classroom. But the reason we are talking about this is because because of the quick decisions taken by the regulators in two different parts of the world, we arrested a risk of contagion, as in we arrested this from spreading to other financial institutions. And while in the US, there is differentiated regulation for small and large institutions or small and large banks. In India, we do not have that kind of a situation. So the same rule, the same regulation applies to a bank, whether it is large or whether it is small. And this is in relation to the stress test that the regulator asks the banks to conduct to check whether they will be able to take on certain situations and simulate certain conditions. So the smaller banks were exempt from this because these are quite onerous and difficult to simulate and also require maintenance of additional capital.
Mm-hmm.
So anyway, irrespective of the size, the lesson we learned is that even a smaller bank failing can lead to a lot of loss of confidence. This loss of confidence can then flow into other financial institutions. There may be interconnectedness of these financial institutions with each other, and therefore what we call a contagion, where the issue can then become larger and spread to other financial institutions and in fact to the whole system. And we did see something like this happen not too far ago. So this is what I thought I'd just share in simple words as to what the banking crisis, the genesis of the banking crisis as we call it was, where we are right now, and what do we think can happen in the future. So I'll just take one line on that and pass over to Madan then, because I think in my personal view, the crisis is not over. Earlier, we were focused on credit because in the past cycle, the reason for failure was credit. But we forgot about interest rates, which was in plain sight. With the rates going up, the interest rate risk was forgotten. So the interest rate risk hit us quite severely. In fact, banks were incentivized to invest in assets or very safe government paper, government securities, which require very low capital requirement, which are very liquid. Technically, they can be sold immediately. You can raise cash and you can pay back any depositor who shows up at your doorstep. But with the rates going up, these investments resulted in the banks showing losses. So you're holding a security which is yielding you less than what a new security can yield, and therefore you have to show the current market value of that security, which is why they started showing losses on account of these securities that they held, which was not fully understood probably by the entire system. And once investors get spooked and depositors get spooked, then it leads to what we call a crisis. So I'll stop there and pass on to Madan. I hope I've been able to set the context in a simplistic manner, and we can take Q&A after we hear from Mr. Madan Sabnavis. So over to you, sir.
Yeah, thanks a lot, Mr. Singh, and good afternoon to everyone. I'll start off on a slightly lighter note because I think this SVB crisis, if I remember right, it had erupted on Thursday evening. Okay, so in Friday morning, I was in one of our committee meetings in Bank of Baroda, where somebody had asked me saying that, what does this SVB actually mean? What is this crisis about? I had my television on, so I saw something coming on ET Now and CNBC talking about what this crisis was, but I had no clue what this particular issue was because it happened all of a sudden, and frankly, I was not tracking what was happening with these smaller banks in the US. And therefore I said, look, I don't know what this means, but let me do some research. So I went on to Google, found out whatever happened about SVB Bank, found out there was something called Signature Bank, Silvergate Banks, rather fancy sounding names. And they all seem to be a similar kind, smaller banks, not very significant, but today they were significant on that particular day. And people were talking of crisis-like situation. And then there was these WhatsApp jokes which went around saying that on Friday, nobody knew what was SVB, but now There are 1,000 pundits around telling what went wrong with SVB, what should have been done, what the Federal Reserve should be doing, and why is the RBI not doing what it should be doing. So almost everybody became an expert on what was happening in SVB. Unfortunate that nobody in the US knew that this kind of a problem was brewing. Now, when we talk of banking or a financial crisis right now, I think the kind of crisis we're talking of today is quite different from what we had in the past. So I would say it's a kind of a new kind of a crisis. And I think every crisis itself has a new storyline, new kind of lessons which are imparted to the market participants, to regulators, because the kind of action which has to be taken when you have a crisis is going to be different depending upon the circumstances. So what do I mean out here? Because if you go back to see what kind of crises have we had, one everybody knows about it, the Lehman crisis, which took place maybe 15 years back. We had something called financial engineering, the CDOs, the CDSs, which came through. There was this huge property boom which took place, and we had all these securities which went for a toss. So then we had a major crisis. Federal Reserve had to finally intervene. We had quantitative easing coming through, which meant making easy liquidity available to everyone. And we all thought that this was a panacea for the problem. Closer towards India itself, I think around 2013-14 or so, there was a major NPA problem which came through. So that was a banking crisis as far as India was concerned. And more or less, I think it was the public sector banks which were in the eye of the storm. The reason being that you had lent a lot of money primarily for infrastructure purposes, and most of them backfired. And probably there was some bit of political interference also. So we had the AQR, which Dr. Rajan became very famous for, the asset quality review. Banks started reviewing their portfolios. Then you realize the NPA ratio was in the region of around 15 to 20% for some of the public sector banks. And then there was an entire cleaning up operation which took place. If I go back even to 97, when we had the Asian crisis, it's again a crisis in terms of the lending side. There was a lot of crony capitalism, as I kept lending to my own relatives, my own friends. And then we had something which went wrong, and then the entire system had to go for a rewash. So most of the crises which we have seen so far are more associated with the lending side. And I say lending side, I give loans which are not being serviced. So therefore, it's a problem for a bank. It becomes a problem for the system, because we realize that the entire system operates in a similar manner. Okay, so when we had the Lehman crisis, we had lots of these banks, all of them which were probably the blue chips in India. We all felt that we all wanted to work in Goldman Sachs, Lehman Brothers, maybe JP Morgan also, Mr. Singh. That was all the names were there, Morgan Stanley, Citibank. All these banks were very much in this particular story. And then you suddenly realize that something went wrong, and nobody really knew before that something was going to go wrong. So if we're looking at the situation today of these smaller banks which went down, I think the situation is very much different. There was not any problem on the credit side. It was not a case of saying that they had taken certain wrong decisions, but still, obviously, things went wrong. And that's what Mr. Singh was talking about. A run on a bank is never a good idea, because today, if I feel that bank ABC is not a sound bank, what will I do as a deposit holder? I will go and start taking my money out of the bank. If I do it and I spread the word around saying that there is something fishy about this bank, all the deposit holders will say we want to withdraw our money. And if all of us want to withdraw our money, there is a run which has taken place. And when we say a run has taken place, the banks have to repay this money. And if banks normally don't keep cash with them, what you do is you either lend it or you invest it in government securities. So I don't have cash to give immediately. I cannot ask people whom I've lent money to return the money. So what I do is I have this whole pile of securities which I have. I start selling them in the market. So in a way, when you're looking at most of these banks which ran into a problem, the issue was that you were holding on to what was considered to be the safest security. Imagine, can anybody think that investing in the US Treasury could be dangerous? Now, all central banks have surplus forex reserves. What do? We all pick up this money. We invest in government treasuries, US Treasuries, because we think it's the safest possible avenue of investing our money. But today we saw what was the revelation was that if I decide to sell these securities, which have depreciated in value, and why have they depreciated in value? Because when the US Fed started lowering interest rates, so the price of bonds were obviously high. So we bought all these bonds. And then when the Fed started increasing interest rates, the value of these bonds came down. So if I wanted to sell these bonds in the market, I would make a loss. And once I get to hear that, look, SVB is making a loss, then it makes sense for me not to keep my money in this bank. I will go and start withdrawing my money. So what really happened was that all these startup companies were dealing primarily with banks like SVB. So what they did was that they kept the money out here. They were also getting funding from SVB. So today, when all of them say, look, I want to withdraw my deposits, the bank is not in a position to give it to me, or they're making losses, it creates further panic. And when we talk of the contagion, it essentially means that similar kind of banks also run into trouble. So when you're talking of Signature Bank or Silvergate Bank, these were the guys who were also heavily into crypto. Crypto was something which everybody thought was the next big thing. Blockchain technology, I don't really understand what that is, but everybody said to get a technology, we need to have Bitcoin, we need to have all these other fancy terms of crypto in the market. Lots of discussion took place on that. And then you see that the value of the crypto has also fallen. The value of, I suppose, all these the Bitcoin and other cryptos have also fallen. So obviously any kind of lending which involves crypto also means high risk, and your business also gets into trouble. Now, in this kind of a situation, how serious is it? So I think one of the early statements which came from the Reserve Bank was that, look, the Indian banks are well capitalized, the NPA ratios are good, we are in a very stable country. We don't think there's need for one to worry. That was the external statement made. Internally, of course, the RBI as well as the government of India called up all the banks, told them, please review your portfolios, see what kind of exposures are there. Of course, Indian banks will not be having direct exposures to SVB, but if I have certain branches in the United States and those branches have some operations involving SVB, there's an issue. More importantly, if I'm dealing with the same startups who have borrowed money from the American banks, and if they're going to go bankrupt, then automatically, if they have borrowed money from an Indian bank, there will be a problem of a possible NPA. So I think these were the issues which were there, and I think almost all the banks, public sector as well as private sector, were to review all their portfolios. And then they, of course, came up saying that they're not too much of exposures. I think the largest bank, SBI, also said that they have a very insignificant exposure to this entire setup. And the government of India created a parallel window in terms of the Gift City, telling the startups that, okay, you have a problem here, we can help you out because Gift City provides you the same facilities which you get in any international market, meaning thereby, if you want a dollar loan, you can get it from Gift City while operating from India itself. So that was a kind of a solution which came through. So I think, and then if you look at Credit Suisse, I think very well explained by Mr. Singh. Another point I would add is that, see, in India, if you look at most commercial banks, we only operate as commercial banks, right? So if I'm Bank of Baroda, I'm State Bank of India, I do only banking, commercial banking. But if you look at Credit Suisse, it was also into investment banking, it was also into wealth banking. So what happens is that when one particular business, the investment banking arm, ran into trouble, you start making losses out there, automatically the risk spreads from the investment arm to the commercial bank. So that's how the problem also gets magnified. So if you look at the Indian system, for example, the very fact that it's made very clear that if I want to run anything to do with the capital markets or anything to do with investment banking, I have to set up a separate institution. So it can be a subsidiary of the Indian bank. But if you're talking of ICICI Bank is nothing else but a commercial bank. You may have ICICI Securities dealing with something. You can have an insurance output in the form of Prudential, Lombard, or whichever way it is. The whole idea is that the risk capital of banks should not be compromised because commercial banks into what we say conventional banking, you're supposed to make sure that since you're dealing with deposit holders' money, it is not being used in an imprudent manner. So that was a kind of a protection which we people got from this entire episode. Now, the important lesson I would say, so one thing is to say that something has happened. All the intelligent people, none of us knew there could be such a problem. Even I thought that the right thing for anyone to do is to invest in government securities in terms of US treasuries. That was the best investment. But what appeared to be the safest asset has turned out to be the most toxic asset because anybody holding on to that would have been so scared. Because just think of it, if the Indian government, we claim that we have around 600 billion forex reserve dollars or forex reserves. Let's assume at some point of time I want to offload $300 billion in the market. The value would have fallen substantially just because of how the interest rates have moved. The price of these bonds have moved. So I think one has to also seriously think about at a macro level as to how do you actually manage your forex reserves. But of course, that is a different issue, not really a banking issue. But from the banking point of view, I would say that the first lesson is that while central banks normally ensure that when you're creating your asset portfolio, there's a lot of prudence which is shown. Prudence in the sense is that there is not too much of concentration which is there. When I say concentration, I mean that banks are not allowed to lend more than a certain proportion of their net worth to a single company, to a single company group, a group company. The whole idea is that we should be diversifying our risk when we are lending money. Similarly, the lesson here actually is that we should also be looking at the liability side. So far, the focus has always been on the asset side, saying that if I'm lending, let's assume I'm lending only to large corporates, infrastructure companies, I could have a problem because if something goes wrong in the power sector, all the power loans are going to get affected, all bank portfolios are going to get affected. So therefore, there are concentration limits on the lending side. But today we get to know that we should also make sure that we should not be getting into too much of concentration in terms of deposits. India, of course, doesn't have this problem because if you look at the structure of deposits in India, I think more than 50 to 60% are retail deposits. There is no concentration in particular entities, whereas banks like your SVB were niche banks. When I say niche banks, they were meant for a certain category of business. So that's how we run into a problem. So the lesson is that we should not be having this. But an interesting question for which I don't have an answer, maybe Mr. Singh can give his view once I finish talking, is that today when we have small finance banks, are we running any kind of a risk because there is too much of concentration out there? I'm lending only to the SMEs. Of course, SME is not a single unit, homogeneous unit. They're spread across different industries. But like, for example, when we spoke of, when you look at the lockdown, which was the segment which was affected the most, it was the SMEs. So if I have certain banks which are catering only to the requirements of SMEs, because a small finance bank cannot lend to the Tatas, they cannot lend to the Reliance even if they want to, because the mandate says you should be lending only to the SME sector. So are we carrying a risk out there? This is a question. I don't think there's an answer for it. Similarly, if you look at your payments bank, okay, we have a payments bank in India. How do you define them? You say a payments bank is one which takes money. You're only allowed to invest in government paper. So are we replicating a problem which is probably there, which was there in your SVB? Of course, in India, things are more regulated. We don't see those kind of dynamic swings in your bond yields as what we have seen in, say, the US. In fact, one of the complaints in India is that if you see the Federal Reserve has increased rates by 450, 500 basis points. And if you look at the 10-year bond, it has gone up by 200 to 250 basis points, of 200 to 300 basis points at certain points of time, the US bond. Whereas if you look at the Indian GSEC, RBI has increased rates by 250 basis points, whereas your 10-year bond has gone up not more than 50 basis points. So the way in which the market moves in India is very much different from how it moves in the US. But I think a fundamental question from the regulatory point of view is that when we have the niche bank concept which we introduced, small finance banks, payments banks, the logical question is, these banks work on the basis of niche business on both on the asset side as well as the liability side. So this is something which should be seriously looked at by the banks themselves and probably also by the regulator. As of today, one doesn't see any problems out there because they have been managing their affairs fairly well. And as I mentioned, SME is not concentrated in any particular sector. They are spread across both manufacturing and services. And to that extent, it may not really be a threat. The second important part is that when you're talking of startups, because I think India is banking a lot on startups, not just for growth, but also for creating jobs and entrepreneurship. And we all know that the history of startups is not very good, both globally as well as in the domestic market. It is said historically and at a global level, 80% of them fail in the period of 3 to 5 years. The mortality rate is very, very high. Because most of these models sound nice, they sound good. It's good to begin with, but they're not scalable. And at some point of time, the promoter also loses his interest. And very often what happens, you set up a startup, and at some point of time, you will sell it off, go in for an IPO. Investors are left holding the junk stocks which are there in their hands. We have seen how most of these startups have performed in the stock market. That's, of course, a different issue. But startups on their own also need to get into treasury management. I say treasury management today, for example, I'll say that, okay, 5 of us are creating a startup or 10 of us are getting together, but we also need to keep a track on the flow of funds, because this became a critical factor when this group of startups were dealing with SVB. How do you make sure that you keep enough liquidity in hands so that you're able to meet your daily expenses. And here I think the major problem was payment of salaries. Okay, because when your money gets locked up in these banks, the next question is that how do I manage my day-to-day running, which also includes payment of salaries, because the contagion could also be for employees. The moment I see I'm not getting salary, I'll leave this organization, go somewhere else. So that could be another kind of a run and a contagion put together at the HR level. So I think these are the kind of lessons which I think which are there, and a kind of a vindication also for the Reserve Bank of India and the government of India that we have not actually officially accepted crypto. I think crypto was a big disaster waiting to happen at some point of time. I always felt that crypto is nothing else but gambling, because we don't have any underlying for crypto. I can create a coin called Sabnavis coin. If all of you all in this particular room believe in it, you start trading in it, it doesn't give any legitimacy to it. But if the whole world suddenly thinks the Sabnavis coin is a great coin, if the value keeps going up, but the financial institutions should definitely be insulated from it, because individuals, if you trade, you make a fool of yourself, it's your problem. But if the financial system is going to get involved in such a system, then I think there are problems, something which has been flagged by the Reserve Bank earlier. It's always against legitimizing it. But I think today even the government believes, after in fact, I think the last year's budget, they actually made it taxable. But I think finally the day has come where we have to take a serious look and make sure that we declare it to be illegal, or you say very clearly that it's gambling. And definitely, I think the financial systems, not just in India, but across the world, I think they're the ones who need to steer away from crypto. I think that's another important lesson. And last, I think the other important part, which is of course there, is that financial institutions, banks, I think while everybody has openly told the Reserve Bank that there are no problems, I think stress tests need to be assuming a different kind of a role. Normally, when you have stress tests, it's done more from the point of view of market movements. You see how interest rates move, currency moves, how your portfolio is getting affected. But I think we also need to look now in terms of the credit risk and do regular stress tests, saying that when we are looking at different parts of our asset portfolio, where exactly is it concentrated? How are those sectors doing? What kind of risks are being held by them? So I think we need to move the concept of stress tests away just from pure markets to also in terms of the overall the credit risk which is being carried by banks and financial institutions. So that would be my initial remarks. Mr. Singh, I would love to have your comments on the SFB and Payments Bank, and then we can, of course, get a larger set of involvement from the audience. Thank you.
Yeah, thank you, Mr. Sabnavis. I really enjoyed what you mentioned, talked about right now. And I for sure have learned quite a few new things from your discussion. Like you mentioned, the concentration risk, the quick growth of SVB, and the manner in which they deployed their funds and the risk management rather than the credit management is the reason why it landed in some kind of trouble. I don't think that may be necessarily entirely all true for the small finance banks in India, though we've seen a number of cooperative banks in India go belly up. In fact, I was going to ask the students if they know the name of an Indian bank that has failed. And very often, it's very difficult to find a name of an Indian bank that has failed. The last one I can remember was what happened to some banks that went into trouble and then were quickly merged into stronger banks, or the very quick action that happened on Yes Bank, which again saved it from failing. A Global Trust Bank was one that I think was going belly up, and which was then merged into Oriental Bank, and that is now Punjab National Bank, merged into Punjab National Bank. So while there has been always the strength of the banking sector in India has been undoubted, we probably don't see the pain that we saw, for example, in the PCMC bank scandal or the bank failing. I think that was a larger of the smaller banks. Otherwise, there are many small cooperative banks that fail regularly, but we don't even talk about it. Makes a small news item somewhere. But if you hear of the local communities that have actually put all their life savings trusting that bank, I think that's where you really realize that these things do happen in India as well. But of course, don't find very much publicity because they are contained to a very small set of depositors and people impacted. So sorry for the long winding answer, but yeah, I think banks that grow very quickly, that don't manage their risk well, could be at risk despite their size. And in the case that you mentioned, yes, there is a concentration risk, and that needs to be carefully managed so that we don't see what happens to cooperative banks every now and then, which is also for many other reasons and interference in their management. But let me stop
I
there
think
and see.
a point to be, yeah. No, in fact, a point to be made here is that, very often banks keep saying that, I think you must have read it in your economics textbooks, that CRR is a major burden. We should not be having a cash reserve ratio. Now, the idea of having a CRR is essentially to protect the bank against a run. Of course, you don't expect wholesale runs to take place, but the idea of a cash reserve ratio is that at any point of time, if there is a run on the bank, at least initially you have an official recourse in the form of CRR which can be used. And if I'm not mistaken, countries like US may not be having a CRR.
Yeah, we came very close to a bank run, if you remember, Mr. Sabnavis, with a bank which is very large today, which is ICICI Bank.
Yeah.
There were one or two instances where people got nervous and there were long queues, people trying to withdraw deposits. But that was a very, very long time ago, maybe before many of the people on this, students on this call were born. But how quickly we forget. And those are now the largest banks in India. So very nice to see that we've overcome many of those confidence-related issues.
And also the advantage we have had in India is that Reserve Bank of India has tried its best. It's always been successful to make sure that deposit holders don't suffer. So I remember even during the Global Trust Bank time, I think that definitely none of you all would have been born at that time. When it went down, I think everything was protected, including the jobs of the employees. I mean, when Oriental Bank of Commerce took it over, they were told you'll get a 3-year service where you get your own salary. After that, of course, you merge into a public sector bank salary or you get a job elsewhere. So I think that kind of protection was definitely provided to a time, which went down.
Yeah, that's right. Amlesh, would you like to open up for questions?
Yeah, I think we are open for questions now. The one question I was just discussing with the students, has there been any known case of a run on a bank due to data security fears? And what in general in India is the situation deemed to be in terms of data security, fraudulent transactions, etc.?
Yeah, I'm not really aware of any such situation.
Same here. I'm not aware of any run on account of breach of data security, but I think those issues are being handled separately by the bank and the regulator.
Okay.
But I agree with you, that can be a potentially quite dangerous. If I get to know that things have been compromised, that could lead to a lot of.
Yeah.
In fact, that's one of my fears of everything making it digital. You always run this risk. Of course, I'm one of the Luddites who's not too much for technology. In fact, when I started off here, I had a problem getting my camera on my laptop. I had to be told the rudimentary thing of move the switch to the left, which I did to get it on. But I think technology should not go ahead of security. And I think that's a problem which I think we may be having at some certain pockets.
Good afternoon, everyone. I am Kimaya Sunami. I'm in the data science program at MDA. So I would like to take a moment and express our gratitude towards our speakers for such a valuable and informative webinar today. I'm sure many of us have questions and comments that we'd like to share. And I'd like to tell my classmates that this is an excellent opportunity for us to connect with our speakers today and deepen our understanding on this topic. So please feel free to either text me your questions or drop them in the chat box here. Also, I think like a question which I received was, are you of an opinion that a worldwide economic recession is likely to occur? Like, would you like to shed some light on that?
I think Mr. Sabnavis can be put on the spot.
Okay, I'll give my view on this. I think, before, when the year began, when I say the year, we're talking of the calendar year 2023 beginning, I think it was largely felt that there would be a recession. A recession is defined technically as 2 quarters of negative growth rate. Okay, so it was felt that there would be a negative growth rate for the Western economies, not so much for the emerging markets, which would probably be standing out. Now, the situation has evolved since then. What we have seen is that the kind of hard landing which was expected for economies like US, the Eurozone and UK is not something which has really materialized. It's going to be more a kind of a soft landing. So while overall economic growth rates will remain lower than what they were in 2022, which also holds for developing economies like India. So even for India, for example, 7% growth in 22-23 is going to be followed by 6.5% if you go by what the Reserve Bank of India announced last week. But we are seeing similar lower growth rates coming in the Western hemisphere. But definitely the kind of recession which was feared at that point of time on account of the Federal Reserve and other central banks hiking interest rates is definitely not something which we are seeing leading to lower growth. And in fact, one should remember that even though we have seen economic growth slowing down, what normally happens when economic growth slows down or we move towards a recession is that your unemployment rate increases. But surprisingly, what we have seen is that in America, unemployment rate remains much lower than their natural rate. The natural rate is 4.6%. And today we're moving at less than 4%. The reason, of course, is that post-COVID, there's been a case of saying that nobody's actually letting go of labor. There's a case of lots of people who have gotten a lot of social security during COVID time, and people don't want to really return to work. So it's been a kind of a drive. The companies have been trying to force people to come back to work. You're not going in for that kind of retrenchment, which was there very earlier. Of course, when I say this, some of you all may turn around and say, look, what is Amazon doing? What is Facebook doing? Yes, that is happening. That is being highlighted basically in the fintech and IT space. But if you look at the core manufacturing and core services, we're not seeing a similar thing happening. So to come back to your question, definitely there's going to be a slowdown in the economy, but not negative growth. The only 2 geographies where we're looking at possible negative growth are Germany and UK. But with the kind of the kind of revolution in China, I think that's going to add a lot of countervailing power in terms of overall global economic growth, which would remain fairly stable during the year.
Okay. Dhumil Shah, one of our students, he asked, since we are saying that the recession, since the crisis is not yet over, he's asking what, as students of economics, what trends and indicators can we look out for? So I guess he's trying to ask us, how can I have a nose for the crisis?
See, in fact, if I'm looking at conventional
was
banking,
in the
I think
US
that the
recently.
factors which we normally look at.
Yeah, sorry, please go ahead.
Yeah, carry on, Mr. Singh. You're the banker.
No, I was only sharing anecdotally that I was in the US recently, and it is some part of it, the labor shortage that we are talking about is real. The cost of labor and the unavailability of labor is a grave issue. And this is also some kind of a geopolitical impact that the US is facing because of their own change in the manner in which they have changed their immigration laws. But the solution to all of that has been outsourced to the Fed. So a political issue is now outsourced to the Fed to solve, and they have probably very few things in their toolbox. And the one was that they have used extensively is interest rates. But interest rates probably to some extent will help by continuing to raise, but they will also have unintended consequences. So when you have a situation like this where the political issues are being outsourced to the to the wrong place, I do think we'll have unintended consequences, and that's what probably we should watch out for. But Mr. Sabnavis, please add.
I was talking about what are the indicators which one should be looking when you're looking at a banking crisis. See, because a crisis is something which never looks that overt, something which all of us can see. Like, for example, when we had the NPA problem in India, none of us knew that the NPAs were as high as what they turned out to be because of the kind of accounting practices which were being used. So I think what was the AQR all about, the asset quality review? So suppose there's Bank A and Bank B, and we are both lending to entity called X. Now, suppose A lent to X, X was paying A, X was not paying B. Then A would still treat it as a performing asset because my debt was being serviced. So what we tried to do was, the Reserve Bank said, look, that's not the right way to go about it. If I'm a defaulter, I'm a defaulter. So therefore, the entire thing had to be called as a default. We also had something which was called corporate debt restructuring, which was a euphemism for NPAs. Because what happened was that if a loan was not being serviced, all I did was you go to the corporate restructuring cell, which was set up by the bankers themselves. And no bank wanted to show it was an NPA because you had to make higher provisions for capital. So therefore, what you did was you said we have called it a restructured asset. So that was a crisis which was brewing. None of us knew it would explode the way in which it did. And when it did, it was, of course, disastrous. Similarly, if I go back to the Lehman crisis, at that time, all of us felt that these brilliant concepts like your CDOs and your MBOs, they were great assets, great way of financial engineering. And how is it that 10 rupees of deposit can be converted to more than 10 rupees of loan? How do you do it? Because of this entire business of securitization, which was used very dexterously. And at some point of time, when we had the real estate crisis, which came through, the underlying value fell, and then we had the crisis brewing. So I think it's very difficult for one to actually foresee when we're going to have a crisis. So the important thing is that we need to have regulation in place to look at all the essentials. When I say essentials, make sure your accounting practices are good, make sure your NPA levels are good, make sure banks are adequately capitalized, make sure there's no dodgy lending which is going through. So you have this entire set of notifications of RBI which are there, which I'm sure holds in all geographies, where you ensure that tells you what you can do, what you cannot do. For example, when you're talking of Credit Suisse, I mean, India was probably ahead of times, or maybe we were too conservative. We always said that a bank cannot be getting into investment banking because we can't have the risk spreading. I remember even when I was in the commodity market, the regulator, SEBI, said Forward Markets Commission was a regulator. They said very clearly that if I'm in the stock market, I cannot be using the same capital to set up a commodity desk. They said you create two entities. You have a separate capital so that you have two separate entities. The reason being that if my commodity business fails, it not be affecting my capital market or my stock business, or the stock business fails, should not be affecting the commodity business. So this kind of regulation is something which you have to think ahead of time, but it's not possible for one to always think of it. So when you look at things like what happened to SVB, none of us would have thought that people would all take your deposits out at the same point of time, and nobody would have thought that. I mean, for almost 10 years, we've been having quantitative easing taking place from Federal Reserve. We never thought that when they start turning around, everybody said, okay, interest rates going up, cost of capital will go up, there'll be a recession. Did any of us think that when the interest rates start going up, the price of your bonds will come down and there'll be losses to be made by people holding it, including sovereigns? None of us thought of it. So I think it's difficult to find out to make sure that no crisis takes place. But I think regulation is always which has to be adaptive as and when you strengthen your regulation.
Okay, there's a question from Karan Shah, and I'm sure it's my good friend Karan Shah. So, and a brilliant question. So, interest rates are going up, EMIs are going up, and hence we are reading in the newspapers that mortgage periods for loans in India, especially housing loans, that tenures are inflating. And the newspapers say that a lot of people, the tenures are going way past retirement age. So how is this going to affect things? Health of banks, or isn't there a long-term scenario here which seems grim? There may be loss of employment. So Is this a burgeoning crisis for us?
If I may. Okay. See, my view on this is that, see, whenever you take a home loan, you take it for a period of 15 or 20 years. And you know very well that in the period of 15 to 20 years, even 5 to 10 years, I would say, there will be cycles when interest rates go up and they will be coming down. So to my mind, I think one should be prepared for the fact that your EMIs get extended, because the EMI gives you the advantage that you pay a fixed sum every year, every month, which holds on for this period. And your period gets extended on account of the interest rates going up. And we should remember that when the repo rate was lowered to 4%, it was an absurd level to be brought in. According to me, it was not a right thing to do. But we did it consciously, saying that we need to protect growth on account of COVID. So therefore, we brought it down to 4%. So for any rational person to think that the interest rates would always remain at 4% would probably not be the right thing. So of course, it does come as a shock for going to 650. Let's assume the repo rate corrects at some point of time. We come to say 5.5%. Because if we look at the average repo rate over the last 15, 20 years, it's been in the region of around 5.5 to 6. So I would say an equilibrium level for a country which normally has inflation of around 5%, 5.5 to 6% repo rate is a reasonable one. Now, we had 4% repo rate, which brought down your retail loan costs. At that point of time, people might have bought houses, taken the loans, thinking that it's going to remain at that level forever. It was probably human to think that way, but definitely it was not a practical way of thinking of it. But if I go back, say 5 years, I think people were paying more reasonable interest rates. Because and also think of the fact that as long as India is a 5% inflation economy, I don't think we'll ever get to 4%. We will remain 5.5%. Your repo rate will have to be in this region of 5.5 to 6%. The days of easy money are over, and this holds everywhere. But I don't think this is going to lead to the kind of crisis. If I go back to the Lehman crisis, it was the same case. The interest rates go up, property prices come down, then you have a problem of selling the property, servicing of debt, all those issues that come up. I don't think it'll reach it will reach that dimensions. And I think most of the extensions have been probably by around 4 to 6 months, is my calculation.
Okay.
My friend Shradesh has a question for PD Singh, sir. So, how do traditional investment banks build their portfolio around VCs? Sorry, my bad. And how do they end up in a situation like the SVP?
Yeah, sorry, could you just repeat? How do traditional
Yeah,
investment
sure.
banks?
How do traditional investment banks build their portfolio around VCs? And the second part is, how could they end up like the SVB situation?
Yeah, so, in the SVB case, they were a full service bank. While they were providing credit facilities that are loans to the VCs, I don't think they were doing what investment banks were doing for some of the startups, right? So for the startups, they were getting loans and funding from SVB, and the startups were also placing their deposits with SVB. That is my understanding. Investment banks were probably helping the startups with their M&A activities or with raising funds or with getting. So while SVB was also doing part of that, I think the crisis that they went into was not because of any other reason, but the ones that we spoke about earlier, which was to do with the interest rate mismatch and the loss of confidence leading to everyone wanting to withdraw their money from the bank. The investment banking is basically mergers and acquisitions, raising finance or capital through the public markets. So therefore, I think while SVB was playing some part of that role for the startups, they were also lending in terms of loans to the startups as well, because they understood them well, because they could see the cash flows, they had the accounts, they saw the flows, the collections and payments that these startups were making, which were all happening through the bank itself.
Okay, I have a question about depository insurance. As PD sir said, DICGC, insures depositors up to 5 lakh. How come private insurance players are not in the game? I mean, the probability of, let's say, HDFC Bank failing, at least to all of us Indians, seems next to none. Why wouldn't they offer an insurance product to insure deposits in at least these reputed banks?
Yeah, I think it's to do with scheduled commercial banks. So the way RBI looks at banks, once they include the bank in the schedule, then it's called a scheduled commercial bank. And once you're a scheduled commercial bank, then it is the regulator's responsibility to ensure that small depositors are not impacted. And which is why traditionally they formed a deposit guarantee institution, which then went ahead and guaranteed up to, it was earlier 1 lakh and now raised to 5 lakhs per deposit that you have in each scheduled commercial bank. So if all the scheduled commercial banks fail and you have 5 lakhs in each, you will get all that money back. But if you have all your money in one scheduled commercial bank with more than 5 lakhs, then you will get only up to 5 lakhs. So really, I think as a depositor, I'm not sure if too many people are actually looking at that, unless you're a small depositor going to a very risky bank. Otherwise, you would yourself manage a little bit of this by, if you have very large sums of money as deposits, you might spread it across a few banks, or you might go to banks that you perceive are very strong. But good point. I mean, I may want to keep everything in, say, HDFC Bank or ICICI Bank, and someone could insure it for me, and I'd love to have that kind of insurance.
Okay, there's another
So since
question.
just one thing, Kimaya. See, the thing
Yes.
about bank deposit is normally one assumes that you never have to actually seek recourse to it. So that's because we normally assume that when I put money in a commercial bank, the money is safe. So therefore, I think no bank has ever thought, and it's a cost for a bank because the premium is paid by the bank. So therefore, nobody has really thought of saying that that's insured for levels above 5 lakhs, like what you mentioned about a private sector bank, or saying that, look, we want to insure even deposits of, say, 1,000 crores. If somebody puts 1,000 crores theoretically in the bank, why can't I give an insurance, get a private sector player to insure it? I think it's considered to be a cost which banks can do without. And we have seen in the past that banks have not really failed. Nobody has really lost their money in deposits, at least of scheduled commercial banks. So therefore, one assumes that it won't happen again.
So my question was actually, why wouldn't insurance companies offer that product to depositors?
No, depositor doesn't pay it. No, because the thing is, I don't pay the money for the insurance. Insurance is being paid by the bank to this Deposit Insurance Guarantee Corporation. So the thing is, there's no reason why I should be paying the insurance as a deposit holder. It's something like saying that LIC, I take a LIC policy and I want an insurance against LIC which may fail. So it's that way. No? So I don't pay any premium. It has to be paid by the bank to the Deposit Insurance Corporation. So it's a case of the bank saying that I'm willing to take a higher, if beyond 5 lakhs, I'm willing to insure you. If you're putting, say, 1,000 crores, I'm going to insure. But I think no bank will say that I'm risky. You'll send the wrong message, actually.
Mm-hmm. Okay. Yeah, Kimaya, go ahead.
Yeah, so this is a question from Piyush. So do recent events such as the pandemic and the war in Europe warrant for revision of the inflation rates in the near term by the RBI, given the resilience of Indian banking sector and the credit growth of 16% in the past 3 years?
See, my view on this is that the number of 4% target, which was fixed by the Monetary Policy Committee, was not something which I would go along with. The reason is very simple. When we fixed a target of 4%, if one just looked at what was the CPI inflation number for the 10 years prior to the time when we fixed this place at 4%, it was actually around 5.5% to 6%. And I think in just 2 out of 8 years, we had an inflation number which was less than 5%. So in this kind of a situation, I think 4% was a very ambitious number to take to. But I will give credit. I mean, economists, I think all of you are going to be future economists. Keep doing all kinds of modeling, and then so I'm sure that there were certain brilliant people who came up with the number of 4. And quite interestingly, this number was reviewed a couple of years back, and it was decided to retain it. I really thought that 4 should have been made 5%, because when we're targeting 4, now just look at it. We are talking of lowering of interest rates at a time when inflation is above 5%. So 4% is actually being kept in the background. It's just symbolic in nature. And today we're dealing with a number of still 5% when we're talking of changing the bringing down the repo rate because inflation has come down. So I think that's and actually quite fortuitously, after we implemented this MPC committee and 4% inflation targeting, for the first 2 years we had inflation in the region of 4%. So probably at that point of time, one felt that this 4% was vindicated by the data which came in. But subsequently, we have seen that we have been going well beyond this number of 4%, beyond even 5%. But the simple answer is 4% still holds. It's not going to change, irrespective of COVID, because it has been reviewed recently. I think 2021, they reviewed it and decided to retain it at the same level.
Yeah. Okay, there are a few more questions. My friend Gaurav asks, do Indian banks consume or like use technology to avoid crisis? Yeah, and the second part I will ask after this question.
No, I'm sorry, I don't have any answer whether banks use technology to avert a crisis. See, the thing is, a crisis, as I told you, nobody knows that there's a crisis. So I really don't know today if there's a crisis which is brewing anywhere in the system. In fact, let me just take you back. I don't want to take, we have already crossed the 5 o'clock time. I can tell you one thing that I joined Bank of Baroda last year. Before that, I was in care ratings. So at that point of time, I think one of the sectors we had largest exposure to was the NBFC sector. And we never knew at that point of time that there was a crisis which was brewing out there. It suddenly erupted and you got to know that there was one default after the other. So even a sector which a rating agency was, I mean, it's not just care, I think even the rating agencies like ICRA and India Ratings, everybody had exposures to the NBFC segment, including, I think, CRISIL had the least, but they also had exposures to it. So everybody, nobody was able to foresee a crisis. Because I think the moment you see a crisis, I'm sure the regulator makes sure that you have certain checks and balances in place. So A, I don't know if you can foresee a crisis, and second, whether technology can be used to avert the crisis. So I don't have an answer there. I don't know, Mr. Singh, if you have any thoughts on that.
Okay. Also, the next question is how can sorry.
No, I'm just saying you can model various scenarios. Prepare yourself in scenarios, and which is what very proactively nudges us to do on our rings. And I'm talking of India as well. There are very complex stress tests that are done from time to time.
So you weren't audible. The audio was
audible now.
Yeah, but the audio is lagging a little bit.
Okay. I was just saying that the stress test gives us, and to extent, if you're using technology in your stress test, but otherwise there's no real technology to avert a crisis.
Yeah. There's one more question. How can government ownership or privatization of banks affect effectiveness in addressing banking crisis in India?
I'll say if you're, generally if the thing we have seen that in case it's a public sector bank which is involved in any kind of a problem, I think things go very smoothly because of the fact it's government ownership. There's a lot of cushion which is provided by the fact that it's owned by the government. So the reason I say this is that when we looked at the NPA crisis, for example, okay, it was primarily in the public sector banks, but everything was set right. Capital was provided by the government of India through the budget. So that's how we saw such an order. So how did the cleaning up operation take place over 5 years? It was a lot of effort put in by the government, as well as all the rules and regulations which were changed and were strengthened to ensure that the public sector banks were back on their feet. So having government ownership did help. If the same kind of a situation happened for a private sector bank, it would have been a different kind of a situation. So today when you're talking in terms of private, now we haven't seen private banks except the Global Trust Bank fail. But otherwise, if you're looking at, again, I'll draw a parallel to saying your NBFCs, which had a problem. They are shadow banks, so they're not exactly banks, but they don't have government ownership. We saw that they had to close down. So we're talking of Diwan Housing, ILFS, they all had to shut down, shut shop, Reliance Capital, because of a crisis which led to failure. So you don't get that kind of protection, you don't get that intervention when you don't have government backing.
Karan Shah has one more question. And if I were to give a title to this question, I guess it would be the de-dollarization debate. He's asking, should RBI continue to hold majority of the reserves in USD? Considering that we believe that the US government will again hit their debt ceiling, and in spite of high interest rates, the Fed has not stopped printing money.
See, it's always a good idea to diversify your forex reserves, not because of the debt ceiling or anything of that sort, but because of the fact that the way in which politics has played out in the recent past, we have seen that let's take a hypothetical extreme example, saying if everything is kept in the form of dollars, and tomorrow, for example, US says that if any country who deals with Russia will lose all their dollars, I'm not going to give you back your money. So that will create a crisis. So I think the whole reason, not just for holding reserves in the form of dollars, but also for de-dollarization of the world economy is a must, because to make sure that we don't fall at the mercy of one particular country because of the fact that they have the anchor currency in the world. See, the euro was supposed to provide a kind of an alternative, didn't quite do it. So I think China is trying its best, dealing with the poorer countries, trying to make sure that you have a yuan kind of a zone which is created. But I think these kind of thoughts will have to crystallize, and I'm sure they will work out in that particular direction. But definitely diversification always makes sense to avoid these kind of contingencies.
And a corollary.
I still believe that the US will never fail, but one never knows. Because the kind of politics which is there, at some point of time, as I told you, we could just have this. See, for example, there was all the time that when we did not condemn Russia, we did not join US handling with Iran gets boycotted by us is something which they could pursue. Fortunately, that did not happen this time. And I think that credit goes to India, that we have actually built ourselves as a fairly good power in the world, economic power in the world, which has to be taken seriously, which cannot be trod over.
I guess a corollary question is, it's true, right, that a lot of central banks have increased their gold reserves. Is this linked to in any way to what you just said?
See, people are moving to gold, yes, definitely to gold, but still if you look at the total proportion of, you go to the IMF data, I think it still shows around 65 to 70% of reserves are being held in dollars.
Okay.
But there will be a movement, yes, gold seems to be more acceptable because it doesn't belong to any country.
This Vaishnavi Verma wants to ask a question. Maybe she can ask herself. Vaishnavi, you can unmute and ask.
Maybe we can make that the last question. Since
Yeah,
I think
we'll do that.
Yeah, hello, I'm Vaishnavi Verma. I'm from SPJN College, and I'm not not keen to ask a question, but I wanted to add some knowledge about the technology to avoid crisis. So I've been learning and researching about it, and one of my subjects, so it's data breach and technology in bank. So nowadays, banks do have technology such as blockchain, which improve transparency, increase security, and reduce the risk for their fraud transaction. And they have also strengthened their internal controls and compliance processes, ensuring that they are adhered to regulatory requirements. So I don't really know that if it avoids it, but yeah, banks are using technology to mitigate risk and enhance the transparency. And one more topic was there, which was about data breach. So lots of companies are prone to data breach risk. So there was one case, JP Morgan, which held in 2014, where there were several claims that lots of data about the customers, like addresses, phone numbers, have been breached. And because of that, the reputation of JP Morgan did go down, and the stock price also. and this actually led to a lot of rumors about JP Morgan. So yeah, that's there. Thank you so much. I hope that helped students.
Okay,
Is
I think
that
we're 15 minutes past, so maybe it's time to end this webinar. Now, for the students, I have a request. You've been here, you've been patient. At the end, we'll play a video about the academy. My sincere request to you is to stay around, and because it will really be informative and give you a lot of information about the academy. PD sir, Mr. Sabnavis, thank you so much for sparing your busy time, being with us, and enlightening the students. We are really grateful to you. And till the next time, PD sir.
Thanks for inviting me.
Yeah.
And bye.
My pleasure.
Bye, Mr. Singh.
Thank you.
Okay. Thank you so much.
Bye, everyone.
Yeah. Bye.
Bye.
Yeah. Anybody on the call from MDAE, Prashant, or anybody else?
Yes, I am playing a video.
Yeah, please go ahead. Omkar, I'm not getting any audio. No audio, guys. And there's an echo.